How's it going, guys? Welcome back to my channel. Today's video, we're going to dive into the Iron Condor strategy using Apple in this example. So AAPL for example. So if you want to look for a way to profit in a stable market with minimal price movement, this strategy might be for you. And I'm going to try to break it down to how it works using pain. Okay. So just want to make it easy for you guys. So basically, what's the Iron Condor strategy? So basically, the Iron Condor is a neutral options trading strategy. Okay, it is designed to profit when the price of the asset, like Apple stock, for example, stays within a specific range by the time the options expire. Okay, so in this example here, I have AAPL or Apple at 180. Okay, and this will be where we're gonna be building up the strategy with the strike prices and whatever, and I'm gonna explain to you in a minute, so just bear with me in here. So basically, this strategy is perfect for situations where you expect the market to remain like relatively stable without significant price movements. Okay, and I'll explain you why. So how does it work? Okay, so to set up the Iron Condor, you need to execute 4 option trades. Okay, for option trades. So let's assume Apple is currently at 180, for example. Here's how you can structure it. So what you're gonna do here is you're gonna sell a call with a 185 strike price. So the first one will be this one, 185 strike price. Okay, let me just put that in black. 185 strike price, that'll be the one. Okay, so here you'll be betting that Apple stock price won't rise above 185 by the expiration date. Okay, so that's the first one. So like I said, you're going to sell a call at 185, and now the second step here will be you're going to buy a call. Okay, so first up you sold a call, and now you're going to buy a call at 120 strike price. Not 120, 190 strike price. Okay, so again, sell a call at 185, and now you're going to buy a call at 190 strike price. So this call is purchased to protect yourself in case the stock price rises above 185, so limiting your potential losses. So just in case the market goes up above 185, this option here is literally saving your account, and like it is protecting you against that loss. Okay, so that's kind of how it works. Now the third step is pretty much the same, but like downwards. Okay, so what you're gonna do here is you're gonna sell a put with a 175 strike price. Okay, so this one will be the one right here, 175 strike price. So on the downside, like I said, you're betting that the stock won't fall below 175. Now the fourth step, or the last step, you're gonna buy a put at $170 strike price. So right here. Okay, so this put is about to protect you against significant drop below 175. Same thing here. Okay, so this option is to protect you against the market going down, okay, or actually below 175. So basically what happens here is the goal with the strategy is for Apple stock to price to remain between 175 and 185 by the time the expiration, by the time the option expires. So the core idea is for the market to stay between this range right here. Okay. So that's kind of how it works. So all the options you sold will expire worthless, okay? And you're gonna keep the net premium in received from the trades, because what happens is when you sell these options here at 175 and 185, you're gonna receive a premium, okay? You're gonna receive a premium. And if you've been trading options, you know what I'm talking about, okay? So that's kind of how it works, okay? And now we're going to calculate the premiums, costs, and limits, right? So we're going to go through a detailed example with hypothetical premiums. So for example, let's say you sold a call at 185. Suppose you receive a premium of $2 per option. So you receive $2 per option in here, and you receive $2 in here. I know it's a really ugly 2 number, but it is a number 2. Okay, so you receive the number 2 per option. And now you're going to buy the 190 call. So now you're going to buy the 190 call. You're going to assume that the cost to buy the option is $1. So what happens is in here, you're positive $2, and in here, you're negative $1 because you're buying that option. Okay. That's kind of how it works. And the same thing with this one. The same thing with this one. So this one is 2 positive and 1 negative. Right? So like I said, let's go through it again. Suppose you receive a premium $2 per option on the selling option, right? Now you're gonna buy the 190 call, assuming that the cost to buy this option is $1. Same thing with the other side. Okay, so you're gonna sell the 175 put. So you're gonna receive a premium of $2 per option here as well, and you're gonna buy the 170 put, right below it, and the cost for this put might be $1, for example. And now the total premiums received will be, so the call side, $2 from selling the 185 call, and the put side as well, $2 from selling the 175 put. So the total premium received is $4 per options. Okay, I mean the total received here is $4. Okay, $4. And that's what it is here. And now the cost. So you have the premiums received minus the cost. So you have the call side, so $1 cost per buying cost at the 190 $190 cost call, $190 call, and then you have the $1 put. I mean, sorry, you have the put side as well, which is $1. So cost of buying 170 put, so 2. So the total price here will be 2. So 4 less 2, or 4 minus 2. So basically here, the net premium will be $4 received minus $2, which is the costs. So in total, you have $2 per contract. Okay, so that's the ideal world, okay, when you profit. So basically, the maximum profit and loss, the best case scenario with this is that Apple's stock price stays between 175 and 185, like I said, meaning that all the options are going to expire worthless, and you keep the net premium of $2 per contract, okay, on this one and this one option right here. And then the maximum loss, basically, let's say the stock price goes beyond 190, so 195, 200 or whatever, or below 170. So anything that is above 190 or below 170, that will be your loss. Okay, below 170 or above 190. The market goes up higher than this, you're literally gonna lose it. Okay, so basically the maximum loss here, the loss are limited by the difference between the stock prices minus the net premium received. So in this case, the difference is $5. Okay, because it's 190 less 185 or 170 less one. I mean, it's 175 less 170. So your maximum loss will be $5 minus 2. Okay, this is 5 minus 2. All right, and then will be $3 per contract. So that will be your loss right here. Okay, so that's pretty much it. Okay, guys, so there you have it. The Iron Condor strategy can be a powerful tool in a stable market like what we expect Apple to be in this example. Okay, so if the stock stays within the expected range, you can profit while keeping your risks limited. So that's pretty much it. So you don't want the stock to go anything above 190 or below 170. If the stock stays between this range or this zone right here, you profit. If anything other than that, you're gonna lose. Okay, so that's pretty much it. Oh yeah, inside that expiration date. So that's pretty much it for the strategy. That's just one strategy out of like a million strategies of not a million, but like dozens of strategies on the options trading market. And keep that in mind, guys. Like I said, English is not my native language, so I might stutter sometimes, but I'm improving 1% every day so you can understand me better. And I'm gonna bring many content, like so many. I mean, I will bring so many videos for the options trading strategy and for this YouTube. So not only will be talking about stock market, but not stock market or Forex or crypto or any types of investments overall, but I'm also going to be talking about derivatives, which is this options trading strategy, and how to combine strategies, how to put them all together, how to generate income using options, and how to use this income to speculate and leverage your money to build your portfolio and whatever. So this way we can build more ways, more streams of income for our future and for us, so we can have a better life financially, saying at least. So that was it. Thank you so much for watching this video. I'll see you on the next one. Have a good one, guys. Bye. Oh, also another thing I forgot to mention. Damn, no, Sam. So this here is the this here is the chart that I actually wanted to show it to you guys, just so you understood it a little better. So basically, let's say this middle line right here is the price of Apple right now, which is 180, for example. Okay, just ignore those prices right here, ignore all of it, just pretend that this is 180, and then like when it goes up, that would be like 185 for the first option, and then that the second option, the second line here, would be 190, and the other side is the same thing. So this one will be 175 and then 170. Okay, so the market would have to stay between this range or this zone right here, okay, in order for you to not lose, and anything above it or below it you would lose. Okay, and the risk here is that you lose everything that you put into the investment, so you lose per option. Okay, so that's pretty much it. Thank you so much. Now I'll wrap this video up. Thank you so much. Bye.